Hi, I'm Keith McCullough. Welcome back. I'm here with Darius, the senior macro analyst on our team. We've worked together for about 4.5 years on all this macro data grind stuff. And what we wanted to get into today are some client questions. Demystifying client questions is a very interesting one. It's a subtle one, but on the road when you're seeing these institutional clients, I mean hedge funds, mutual funds, etc., there's a commonality or a thread of concerns, questions. And what I wanted to do with Darius today is kind of get into that. He and I are in these meetings, obviously. We're writing them down. We're asking ourselves where we could be right, where we could be wrong. And the first question is, isn't rates rising bad for growth?
That's a good one. We get this one all the time, Keith, particularly from the Keynesian community. And, this is one you can answer with the question, is the price of money determine economic activity, or does economic activity determine the price of money? Our answer on that, it's a bit reflexive. Economies are reflexive. The signals that go in and out of the economy, like strong dollar, rising interest rates, are reflexive.
George Soros would say markets are reflexive. They feed on each other. They chase one another. Again, what markets actually do.
And absolutely. And if you could see the chart there, it shows you that in a strong dollar, rising interest rates environment, GDP growth is about twice as fast as it is in a weak dollar, falling rates environment. And on the margin, from a slope perspective, GDP growth tends to accelerate versus decelerate in a weak dollar, falling rates environment. So that's one of the things we've been keying on of late.
Well, it's interesting too, because with clients, there's a political end, there's a positioning end. Certain people are long this and they're short that, or they're Republican this, or they're Democrat that. The point is that the macro market doesn't particularly care for any of that. The bottom line is that rising rates and a strong dollar equal better growth environments, does it not?
That's what the math says.
That's what the math says, so we'll go with the math on that one. How concerned are you, and this is the second question, and again, we're trying to pick the top 3 questions that are on people's minds. How concerned are you about a major dislocation in credit markets?
That's an interesting one. So a lot of our bond fund clients, particularly the larger guys that have these very large, particularly levered positions.
Very levered.
Very large, very levered. They're worried about the lack of liquidity in the bond market. And what they saw in June and August was a severe lack of liquidity. I mean, we had a client say, quote, if something's down a half a point, there's absolutely no bid.
Yeah, and what they meant by that half a point in bond speak, in something like an illiquid corporate bond or in a really illiquid mortgage-backed security, again, a lot of people are long this stuff, but it's not a two-way market. People can't get out of it. So if it's down a quarter to a half a point, the thing goes no bid. They can't get out. Okay, Ben Bernanke, congrats. That's what you did to that market.
Absolutely. So if you look at this chart, it shows primary dealer positions in corporate securities going back 10 years. The peak was 2007 at $270 billion. Right now, we're trending somewhere around $70.5 billion, and that's about 1% of the total U.S. credit market versus 4% back in 2007. So what we've seen is a secular decline in bond market liquidity. At the same time, we've had a secular increase in outstanding credit.
Yeah, it's crazy.
That's a complete mismatch, and it will be an absolute gong show, particularly if the Fed comes out and tapers at the December meeting. Only the Fed would be dumb enough, knowing the state of the bond market and the fact that it's a week before Christmas, to come out and taper then.
So that's why we don't think the Fed will. It's not about what we think the Fed should do. Of course, the Fed should have tapered. The dollar should be rising. It's not. So what you got is what you get. Trade the market you have as opposed to the one that you want. And this is a market that you have. You can't get out of it. Okay? Ben Bernanke, you can't get these people out of the market. That's why the bond bull lobby is so loud. And that's why our equity clients are so concerned about a credit dislocation. You can see this in every single meeting. And by the way, these are the players in the game, not people who are just running around spewing about the game. They can't get out of these positions. So again, at some point, we believe the chickens will come home to roost. Probably not at the December meeting, but look forward to 2014 on that one is what I'd say on that.
It's going to be a fun year.
Third question has nothing to do with a complete dislocation in the bond market, thank God. What's a better short here, crude oil or the U.S. dollar?
Keith, that's probably a better question for you, but before I turn it back to you, I will say that the net long position in the futures and options market in crude oil continues to be by far and away the largest net long position amongst the hedge fund community.
Right.
So they're very levered long this crude oil trade, and you're starting to see that break down from a quantitative perspective and a correlation risk perspective. So who knows?
No, exactly. Well, I mean, and we like that answer. By the way, with clients, we like that answer. We're very comfortable with that answer. I think that's why we do, knock on wood, that's why we're doing okay with our clients, because we don't have a predisposed answer. It's not a theory. It's not an ideology. It's based on correlation math. It's based on trade trend tail math, which is our quantitative process, and it's based on net long positions because a lot of clients, sharp clients, fade the net long position. So in Darius just said, look, the biggest net long position out there in anything macro right now is in crude oil. So that makes it a good, interesting short. Maybe not after it's gone down for the last 3 weeks, but interesting. The next one is the dollar, though, and I'd probably go with this one, if only because of the correlation math. So can we explain to people what the correlation is? Because typically, even the most astute and sophisticated institutional clients don't know what that is in the moment because it changes so much.
Absolutely, and it's great that you hit on the fact that it changes so much. A lot of folks measure correlation on very singular data points. We measure correlation across many factors, many durations, and across many different asset classes. I want to say about 350 to be total. So I mean, it's a lot. We're constantly monitoring correlations and looking for changes on the margin in correlations so that we can find changes on the margin and the causation in the story so we can put the storytelling behind it.
Right.
Absolutely.
Whereas most people turn around and they always think that there should be some causation to the correlation. This is what you learn in business school. Causality versus correlations. I mean, come on. I mean, look, the market gives you, seriously, if you've ever traded a real market, the market's correlations change every minute of the day, by the way.
Totally.
And one of the most obvious trades right now is the inverse correlation on an immediate term trade basis, that's the duration, immediate term, between gold and the US dollar. It's minus 0.78. Which basically means you buy gold and you short the dollar here. So that, instead of using the answer with oil, which is already playing out, I'd go with short the dollar and long gold.
Absolutely.
So these are, some of the things that we talk about. We'd love to try to give you more and more insights on this. I know it's an interesting topic and one that we got to get through relatively quickly to try to simplify it, but we just wanted to give you an inside peek in terms of what our days look like. So that's it. If you have any questions, compliments, concerns, I'm at Keith McCullough. That's my Twitter Hedgeye handle. And Darius Dale, you can find him on Twitter too. He's becoming quite prolific. He looks like Russell Wilson out there on the Twitter sphere. So ping him too. Thanks.